Good afternoon, folks, and here's another edition of the weekly wrap. So let's dive straight into some of the issues confronting us in the headlines. And the one that is bothering all of us today is the El Niño effect. Deficiency in rainfall. We are reading that we've got the worst possible June in many decades as far as rainfall is concerned. And we are reading that the El Niño effect will have a greater effect towards August as we go, and that is when we will probably not have the kind of rainfall we were used to having. And the mind races, the articles and the headlines race. And I have a wonderful article here in the Business Standard by Mohan Shenoy and Deepak Gupta. And their attempt here is to debunk the simplicity and the rumors around this and get facts into place. And they've been able to get a pretty interesting set of facts, all by simply analyzing and putting down the numbers for every year that we've had a deficient rainfall. Results are pretty surprising. So let's get into that. Okay. So first of all, they say the common mindset: weak monsoon, oh my lord, there's going to be inflation. If there's inflation, interest rates will go up. If interest rates go up, demand will fall. If demand falls, corporate earnings will fall. If corporate earnings fall, then equity markets will fall. This is the way our mind races commonly. Okay, and even today, that is what is blaring out from headlines. But actually, the duo have analyzed all the years in which the El Nino had a negative impact, right from 2005 onwards to 2024, when we had the last El Nino effect. And against each year, they have checked what was the deficiency in rainfall, and then how did the markets react in each of these years, what was the inflation in each of these years, and which sectors did well, which sectors did not. So here there are no biases, simply a set of numbers. Okay, and we've had episodes of sometimes weak, sometimes moderate, and sometimes a strong El Nino effect, and even a very strong El Nino effect in 2015, which was the financial year FY16. Okay. We've had deficient rainfalls ranging from -6% in 2024, -14 in 2015, -12 in 2014, -22 in 2009, and -13 in 2004. Okay, and strangely, my friends, in each of these years, the markets were up. They were not down. Okay, they were up in 2005 when we had a 13% deficiency in rainfall. Markets were up 28%. In 2010, when we had a deficiency of 22%, the market was up 20%. In 2015, the same thing happened. Even though we had deficient, we had markets up. Only in 2016, the markets were down 6% a bit. That too for a different reason. In 2016, the markets fell because globally GDP was very weak. China was underperforming in its economic output, and hence, because of that weak sentiment, the markets were down. So doesn't this run contrary to the myth that if we have a weak rainfall, a deficient rainfall, markets will fall? No, there's so many other factors acting in the background which we fail to see. Most of the sectors, auto, banks, consumer durables, FMCG, all did well in these periods. Real estate was weak in these periods. So it runs a bit contrary. What happens then to rural consumption? Isn't it supposed to be down when monsoons are weak? So actually, if you're looking at stock market sectors, and the duo have taken the proxy of tractor sales, and I think we are able to see a greater impact of weak monsoons on tractor sales. Okay, 3 out of the 6 years we've had falling tractor sales. The other 3 years we had growing tractor sales. So it's a little more inclined towards weakness than strength, but that too half and half. Okay, but we may probably take that as some kind of a proxy to rural consumption and say that yes, a weak monsoon does impact rural consumption. Okay, but stock markets are not as much impacted. Let's face it, a few years back, agriculture constituted more than 40% of our GDP as a sector, followed by manufacturing, and then services the bottom. Today, services is the largest component of our GDP, followed by manufacturing, and then somewhere way down is agriculture. The composition of our economy has changed, hence our sensitivity to a weak monsoon as an economy is far less than what it was earlier. And even food inflation may not be as scary as we project it to be, because the government has huge buffer stocks of food grains which can release if there's a shortage of food production, which can happen in a weak monsoon time, right? So there are a number of things which have changed. There are a number of factors which are driving the markets and the economy and how they interact. And unless we look at data in this beautiful manner, as these duo have said, we are not able to take the right call. Okay, and while on this subject, I might also talk about Newton's first law of motion. And Newton's first law of motion, if you remember your school physics, simply said that if a body is at rest, it will remain at rest unless something forces it to move. And once a body is in motion, it will remain in perpetual motion in the same velocity and direction unless some force makes it change direction or puts it to a stop. Okay, we always forget about the second part of this equation, of this law. We think that once something is set in motion, it will continue in the same direction, the same speed forever and ever. We don't remember that there are other factors that can act upon it and control the situation. So in the recent past, if you think about what was happening to the currency, we saw the rupee weakening, and then the doomsday people came on the screen and said the rupee will weaken and weaken and weaken, and we are all doomed to be in a depreciating currency. What happened? We are recovered almost 4 rupees from there, and we are at 94 and a half instead of 98. Is it not? So the government did something there. They enabled banks to campaign for FCNR deposits with NRIs at a higher rate of interest by covering the cost of currency risk. Okay, and this as an act itself sent a signal to the market that there would be a larger inflow of dollars into India and cool down the market. We are yet to see the actual receipts come in, but over the next 3 months, there is an expectation of $50-80 billion coming in this manner into the countries. Whether it is 30 billion or 50 billion, whatever it be, there would be a good inflow of dollars. Second, we saw bond rates going up. G-Sec yields had crossed 7% because of worries on the inflation, worries on the currency front, etc. Okay, and we had big articles in the large publications saying it is not the time to be in long duration bonds. You should probably sell out your long duration bonds because you're going to face losses there, and bond yields will go up and prices will keep falling down. That exactly was the bottom. Since then, bond yields have recovered, bond prices have recovered, and bond funds have recovered. And if you had sold out at that time, you would have missed out on a huge gain which happened subsequently. What had happened? Again, the government intervened. What did they do? There were some irritants to foreign institutional investors buying government bonds, and that was taxation. Okay. Generally, foreign institutional investors in other countries are not taxed on the gains in that country. They allow the country in which the institution is domiciled to be taxing them. But India was not doing that. India was taxing the FII here on bond interest and bond gains that they incurred here. Okay. They removed that. The moment they removed it, the irritant was gone, and in the last 4 to 6 weeks, we have received almost 50,000 crores of buying for government bonds. Okay, and bond yields reversed. Bond prices went up because of the demand. And if you had allowed your mind to be swayed by what was being in the headlines and going with the theory that once something is set in motion, it will continue in the same direction, there are agencies to act and control. Always remember, the government is there, the central bank is there to help get things back into control. Till then, we have to live with these doomsday predictions and depend on the sanity of our own mind, and not to forget, look at the numbers carefully before getting carried away. The same thing is now happening in stocks. Okay, we are seeing the IT sector falling and falling and falling because of AI, correct? But here today I read in the newspapers that we have some managers who are taking contra calls. Okay, and they are of good repute, like say Arona, Komkar, or Parag Parik. They've been loading up on IT stocks, and their call is yes. Now the stock price have fallen so much, but the businesses continue to throw out good cash flow, and cash flow yields are good, dividend yields are good, earnings yields are good, and it's a fairly good probability of them being a winner going forward. Maybe it will take time, but from this level they find it attractive. Yes, so we have somebody here who's saying the same, that things will turn around, it will not continue to fall. Maybe a few months later, when we have a weekly wrap, we'll figure out whether these managers were right or wrong. But remember, there can be contra calls. You need not go with the narrative always. Examine it and then take your call. Okay, so that's all for this week, folks. Have a good weekend.